Tim, good morning. Welcome to Premarket.
AB, I haven't seen you in forever. Nice to see you behind the mic.
They've been keeping me hidden away in a back closet, but Dennis and Joel, dragged me out and they got me on air today. So thank you to Dennis and Joel for that. Good to see you, Tim.
I thought you'd just become an executive management muckety muck.
Something like that. They keep. I'm upstairs now in board meetings, and I'm usually wearing a suit. But
you had to dress down for the show because I wear t-shirts and you don't want to really outdress me there. So it's a Benzinga t-shirt I'm wearing, so that's okay.
Tim, how are you, Happy Monday.
How are you?
Well, thank you. Yeah, doing all right. I had if it looks like I'm peering down at you, I had to swap to my Microsoft Surface because I couldn't connect to the show with my laptop, which apparently has been 86'd from Premarket Prep. But this worked. This is the fallback plan. How are you guys?
Good to have
How you doing? Welcome back from Disneyland.
Yeah, I know. I was down there.
Did you lose a child down there? No? Everybody made it out? Okay.
We did. I had a little bit of a headache. I rode that. We went to Animal Kingdom and I rode that Everest ride with the Sasquatch ripping up the track and stuff. And man, I had a 3-day headache after that ride. It's dropping you backwards and then dropping you in the dark. And I was like, I had definitely had buyer's remorse riding that ride. I'm getting a little bit old, but it was just me and the 2 kids. And my boy Spencer really wanted to ride it. The girl was kind of petrified, but she did meet the minimum height requirement. So I said, you just bury your head. She buried her head the whole ride. I should have buried my head apparently too, because my head has hurt for 3 days from that ride. I'm not made for roller coasters anymore. Yeah, that is us on Space Mountain. So that was on Space Mountain. You can see I'm very much enjoying myself. The little girl's like in awe. I'm like, please let this end soon. Please let this end soon. And the boy was very interested too. So yeah, that's pretty much the story of me on these rides. I was riding it just so the kids could go, toughing it out.
I believe that's your bear market face. That
I'm going to have that going in January here. But Tim, let's talk about the lack of a bear market here. I mean, this market is off and running. Is it seasonality? Is it just the fact that, everybody's just got the bull hat on and the bears have went into hibernation here? And what do you see for the next week? And then also I want to look at your further outlook into January here. What does market structure say about the next week though?
So I'll show you what the math indicates, but here's my general assessment, Dennis. And I think about what the money is doing. I always say that if you want to understand the stock market, you have to understand how it works. You have to have some baseline in market structure because that's how prices are set. And number 2, what the money is doing, which is a point of continuous frustration for me with big public companies because they don't seem to understand what the money's actually doing. Here's what it's actually doing. We've talked about this before, so those who hear me, apologies for the repetition. It is partly due to my deteriorating mental faculties because I'm getting old. But it's also purposeful. So you have to realize that 70% of assets at the 7 largest money managers in the United States run on models. It's not that the market is a continuous a reflection of people's views of fundamentals. Big models determine what the exposure to equities is going to be, and they make changes. And then you juxtapose that with market structure where there is no liquidity. I mean, it's just unbelievable. I traded LUV on Friday. I bought it, dumped it, bought something else. I bought CCL and I bought SPXL when the market pulled back to level because the bias in the market is clearly long. So I knew that would be a profitable trade. And my trade for LUV, I own 900 shares of it. And when I sold it, it split into 15 different trades for as small as 6 shares. So if I can barely get into and out of a stock, imagine what BlackRock, Vanguard, and State Street are going to encounter. So if the models come to the end of October and say, well, the market's down 10%, I think we should increase our exposure to U.S. equities by 5% because we look at the global macro models, we feel pretty good about it. You do that one thing, and it can drive the market up 10%, and then people misconstrue that as, okay, we're off to the races again, and it's a bull market, and everything's awesome. Well, it takes that long. And the irony, and I'll finish with this, is that we are going to rebalance, and Joel, you touched on this, The S&P rebalances reflecting the reconstitution in early December will occur between this week and next week. It's technically around the 18th of the month, but Thursday options start expiring and they extend into next Wednesday, the 20th. So in between there, the models now are all overweight, out of whack. Things have moved like pistons all over the place, and everybody's going to try to square the books. Now, I don't know what's going to happen. We can talk about that. But to me, Dennis, what the market tells us is about what the money is doing and about the paucity of liquidity in the market and really little else. And you have to be careful. And I'll show you how to know, traders, when you should be careful.
You got that, screen sharing on the Surface. That's funny. The thing about the Surface, they're so small. Don't your shoulders get tired typing on that thing?
I'm not a broad-shouldered Hulk like you are, Joel.
Yeah, that's true.
Guns.
Joel swims. Joel does butterfly every morning. Joel's doing butterfly, getting those traps going.
That's what it is. So with my nominal shoulders, I can get in front of it okay. But yeah. So if you want now, Dennis, you were about to weigh in on that because you're a market structure guy. You know this stuff. At least probably better than I do.
I don't know about that.
So here I'm going to go to this because here's how to know, traders. If you want to know when the turn will come, this is the way to see it. So as long as I'm looking at just this is a portfolio. And it's got 5 stocks in it for today. And this is the slamming into the ceiling demand at 10, and the supply side has been trending down. If that condition continues, the market rises. It is as simple as economics. When there are supply-demand balances, prices rise. And it's true in anything, including the stock market. When those conditions are about to change, you will see one side or the other begin to deteriorate. Sometimes it's the demand side. Sometimes it's the supply side. Well, look at this. Look what supply is doing in this portfolio. As we start to move toward options expirations, the supply side is starting to increase. If there's any faltering in demand, the market will decline. This is why, Joel, you and I talked about this. I said there was a 67% mathematically likelihood that the market is lower at the end of the year than it is last Monday. Now we'll see. People who make those kind of pronouncements generally are rendered fools, and there's a high probability I'm rendered a fool, but it's mathematical. I kept 4 of the same stocks in here just to show folks. The stocks that you and I talked about last week, Joel, were Block, Square.
Yeah, I saw that.
Right around there.
I loved it because look at the demand and look at the supply. So as long as supply continues to trend down and demand remains strong, this is price. What will price do? It will move up. But what is happening now? If you want to know when to leave something, people, if you need an exit signal, there's your exit signal. It's not that it's extreme. It's only 45%. Supply is 45%. It's almost
ticking higher though.
But it's jumped from 32 to 45 in 4 trading days. That's a big move. And it tells us that the machines, the Citadels, the Virtus, the GTSs, the Tower Researches, all the firms that assess all the tick data are going, I think we're going to start to shift short. They know, and that gives us the ability to see. And the same condition is true with the other 4. I've got Snap in here as a good choice. But if I look at Natera, same drill. This was a good stock to trade. But look what's happening to the supply-demand balance. Same thing. 10, supply plunged. That was a great opportunity to trade Natera. But now supply is trending up and heading back toward, still low. But all those are signals that are predictive and tell us that things are beginning to change. And day over day in the S&P 500 on Friday, for the first time in a long time, supply ticked up. Now, again, that's not a trend. A day is not a trend. 2 days is not a pattern. But that now that's got my attention because I think that there is a probability based on those. I already knew it mathematically that when we get to options expirations, the market's poorly hedged right now. and I can prove it to you. And B, the big institutional money pegged to models is out of whack with those models, and they're going to have to do some adjusting, and that can destabilize the market. Again, I'm not predicting it. I'm just saying when there is risk, the prudent foresee evil and hide themselves. I like to step around those events so I don't give up my gains. I'm sure you guys have too. The whole market has been awesome, but you don't want to give it all back.
I mean, market timing is that in itself. It's like if you can avoid those downturns when everybody else can hit in the downturns, you'll outperform just because of that. So just being on the sidelines in times of distress, will make you outperform the market there too. So we always think about, I have to make these trades to make more money than the next guy. Sometimes just got to avoid the losses to make more money than the next guy.
Exactly right. The people who win are the ones who don't see the declines that everybody else does. It's very difficult to outperform the market mathematically. It's very, very difficult. And you say, well, why is that? Well, because the entire market is uniform and driven by models and priced by machines that consume all of the available data and take very modest risks. I always say, you've got to look at what's the daily volatility in the S&P 500 stocks? Call it 2%. What's the daily volatility in SPY that tracks it? 1%. The arbitrage opportunity for Citadel to make $15 billion is between 1% and 2%. They'll change the prices over and over and take little tiny pieces and break trades into pieces just like I described. So we have to know that. That's why we pay attention to volatility. I want to know how much does a firm move on average every day over a 5-day rolling average, because that's how Citadel's going to move the price. Well, 7.6%. What if I took half that? Because I'll get half of it. I can get half of it because I can't beat Citadel. They have better information, better systems, they're faster, right? But I can take half that if I know the supply-demand balance and Citadel's willing to fill my trades and give me that. All right. Well, you just have to work within the constraints that the market will give you. If you're out thinking that the market's 1995 and what's the multiple on this stock and what's the forward outlook and is it a great business? Those are good considerations, but they're not how the market works today. I would that it were, but it's not true. If you want to evaluate businesses that way on the three bases of valuation, which are multiples of earnings, sum of the parts, and relative value, the only thing left in the stock market is relative value. Those other things are private equity. Okay.
So we talked to you a while ago, and there was no stocks in your momentum filter, momentum opportunities, and it turned out to be a good buying signal. What's in there? What's in there
There's
now?
A lot of stocks in here right now.
We were up to about a dozen last Monday. We hit 26 on Thursday, I want to say. Now it's back down to 15. By the way, momentum is not correlated to the market. This portfolio is not correlated to the market. We don't rely on that statistically as an indication of what the market will do. We rely on it as a signal of an opportunity to make money in 1 to 5 days. That's really it. If the market is much more correlated to low volatility, even that's not awesome. It is most correlated to supply-demand divergence, 75% correlated to supply-demand divergences. So if there's a divergence, the market rises. If there's a convergence, the market falls. That's a 75% probability. This is about 30% correlated. This is not correlated, but it peaked and it's beginning to decline. That is a signal that the opportunities to make money trading volatility are starting to fade. And so that we get a predictive signal so we're not caught out. I always say options expirations.
Yeah, let's talk about that. Let's wrap things up. Want to know about options expirating starting Thursday, quad witch on Friday. You said going all the way out to Wednesday. Right. I mean, it's setting up strong. What are you seeing regarding it? What should traders and investors be aware of for the upcoming final quad witch expiration of 2023?
It's the last one. Well, it's important to know that close to 20% of market cap rests on derivatives. That is, they're substitutes, they're hedges, and they get, what's going to happen? They're going to be rolled, maybe. People are going to increase exposure, going to decrease exposure. Those three things play out through the series that is lapsing and the new series that is resetting Monday. And it's, look, I know there are 0 days, there are weeklies, those are huge, but they aren't used for hedging. They're unreliable as hedges. The reliable hedge is the monthlies because there's an actual asset movement associated with it underneath. Call it 20%. And so if everything's smooth and normal, you don't see it because everybody just rolls their positions and it all works out. This is broad sentiment heading into expirations. It's been above the red line for a really long extended period of time. Now, when those long periods above the red line conclude, tends to be rough. Now, I'm not saying that's going to happen. I'm saying that mathematically it's possible. And the supply side that had bottomed here, shot up, come back down, could reverse. So I look at options expirations as a risk. And it's Thursday. Thursday is index options and futures expirations AM dated. Friday, then those settle Saturday. Monday, a new series trades. Tuesday, the banks square the books on the outgoing and incoming ones. Did they get the balance right? Do they have too much supply or too little? Wednesday are VIX, or volatility as an asset class, expirations. Then we're finally out of that period. In the middle of that is a 20-year U.S. Treasury auction. Now, I mention it because to me, the single biggest risk to the market now are weak, long-dated Treasury auctions. We had one last week. Whoa, rippled through the currency markets, rippled through hedging. The yen moved sharply. Those are the things that really affect the way that global macro models work. So that's, I'm concerned. We got, the government has auctioned $21 trillion of paper. That is notes, bills, and bonds so far. And it will be an all-time record. We're going to do more paper this year than we did in the pandemic when we were trying to paper over our fear with money. So wow. I get concerned about these long-dated treasury auctions.
Yep.
Yeah.
All right. Tim Quast, CEO, Market Structure Edge, joining us on Pre-Market Prep. Thanks, Tim. We'll talk to you again soon.
Good to see you guys. Have a great week.
Thank you, Tim.